Alrighty, guys. This one's going to be about the USD yen. So I just want to show you this really, really good trading opportunity that's coming up, or that's in play now, and could be a really, really good long setup. So it could be a good hold for quite some time, but I'd suggest holding it, but managing the trade on a regular basis. And I'll explain why later. But at the moment, I kind of want to show you the thought process in terms of how I dissect this trade and find an entry, basically, right? The best entry. Now, a lot of people say that this is gambling. It's impossible to find the bottom. It's impossible to find where the market's going to turn, all that stuff, right? And I used to think like that, but it's I can pick the bottoms now or the tops or wherever it's going to go pretty well, right? Um, and it comes down to a lot of different reasons, but which I won't get into now. But I want to just kind of show you what I'm looking for, okay, in terms of just analyzing the chart. So just looking at this, you can already see just quickly. Looking at the daily chart, you can see that the market's kind of rallied since 2012 and it's come into resistance at these levels, and then the market's rolled over, which is kind of expected. Now it's come down to test previous resistance, now turned into support, and the question now is where is it likely to go next, right? Because that's the first question that needs to be asked, which is what is the market doing, and what is it? Well, two questions: what is the market doing, and where is it likely to go next, right? Based on its current location. And then from there, you would be like, okay, well, if I were to enter here or enter wherever I think it's going to go, what is the risk to reward? Okay. So just looking at this, one of the first things I usually do, right, is look for where price is in relation to the ratio levels, the Fibonacci ratio levels. So right now it's at the 38.2%, which is a key level. You've got the 50 and the 61%, which is the three I look for in terms of trend continuation setups. So right now it's right there, which is where you would expect. So the next question is where is it going to go next, right? What's it going to do next, right? So in this instance, I wanted to show you, just before I go for any further, I want to show you this little pattern that comes up. So what I've noticed in the past, and is this kind of, I don't even know what it's really called yet, but I've shown you on a few videos, but the market kind of does this, right? It kind of does this stair-stepping kind of motion like this on a downtrend, and then eventually what happens is for some reason, it just breaks down, right? Breaks down and goes down to some level, finds a bottom, and then quickly reverses back up. That's what's happening. That's what I see happening now. Now, will it play out like that? I don't know. And this is not to say that I'm basing my decision on that pattern, right? I just thought I'd show you that because it's something interesting to look for. But what I'm going to do is I'm going to break this down into the 4 hour, okay? Now, just remember, I'm looking for a long opportunity, right? But in the process of doing that, there's also a shorting opportunity, okay? For a short-term trade. So I'll show you that now, okay? So you can see the market's come down. It's clearly in a bear trend, right? It's clearly bearish, right? It's making lower highs, lower lows, okay? Now, what it's done now is you can see how it's come back up here to test previous support, now resistance, and it's putting a double top, all right? Now, I wouldn't like to call this a double top on the 4 hour, all right? But it's presented another trading opportunity, right? To go short, right? So I'm showing you the long, overall I'm showing you the long setup, but I want to show you there's also another shorting opportunity. Now you don't have to take the shorting opportunity. You don't have to short this if you don't want to, right? But you can use, what I'm showing you is you can use this setup to find the entry for your long trade, okay? Because the question is, where is it going to go, right? Where is a good entry? And if you're looking for an entry further down, you need to find out, well, what's the market doing? Where is it likely to go, and where is it going to go to, right? So what I'll do is I'll go down to the 1 hour because it's going to be a bit more easy to see, right? So looking at the same chart there, right? Now you can see now it looks a bit better when you do this. It looks better. It looks more. You can see this. Look, okay, that's a double top, right? Because before the chart was still too. Yeah, but anyways, so you can see here it's market's put in the double top, and then it's gone back down, and we've broken this structure level, which is important. So now which basically just went all the way down there, broken all these structure levels here, and then found a short-term bottom. And the market's gone back up to retest the previous resistance levels, which it didn't really quite get there. And then it's gone back up again, and then now we're kind of putting in this little pattern there, right? So we've gone back into previous support, now turning resistance. Okay. So this now presents a really good trading a setup. Basically, it's a setup called a 2618, right? So it's basically the double top traded in a safer way, a conservative way that I was taught a while ago, where the market kind of puts in. So what happens is when the market puts in a double top, what people generally do is when the double top's confirmed, right, on this green candle there, at the next candle, once it's confirmed, the next candle you'd be entering short, right? Which is fine, right? It's a decent strategy. And then if you did that, you would have caught this big move down and you would have made a shitload, right? What I don't like about double tops is that it can whip around a bit, and it's a 50%, 50-50 strategy, and you get caught out a fair bit, right? So that's why I don't really like trading it. But I like to still look at it as if other signals line up, then I'd look for an entry, right? So the 2618 is basically you're waiting for the market to kind of play out and then reverse into a 61.8 Fibonacci retracement, right, for an entry. It's just a safer way to trade it. That's all it is. So what you do is you find a top here from the entry bar there, and you do a Fib retracement. You're looking for a 61.8, right? So which is here. So the market, you can see the market came right into the 61.8 and then reversed, right? Came back down again. The other thing also is you want to look for bearish divergence, right? So you can see here, if I draw a line there, at the top there and here, right? You can see the market's putting bearish divergence, right? So you can see clearly that there's some divergence there. It's not, you don't have to check for this, but I like to look for it anyway. If you're trading a double top, you definitely need to see that to see if there's any kind of bearish divergence. So the idea is that as the market comes back into the 61.8, you would go short, right? Now this is already played out, so this is happening now, but you don't have to enter straight away. You can wait for it to kind of pull back up to some level, and then you can look for a short. So it's still an opportunity to go short. Now people will say, well, why don't you just wait for it to go up, right? What if it goes up and why don't you wait for it to come up to this structure level and then short it, right? And the answer is, yeah, I can do that. I can wait for it to go as high as there if I want to. But this is how I was taught, right? These are my rules. My rule says that it's 61.8%. Now, yeah, sure, I can probably miss some of the profit here. I could have entered here and gained some of the profit there, right? But there's pros and cons, right? What if I miss it? What if it doesn't go up there? What if it just keeps going down, right? Because when you enter the trade, the rules is that your stops would have to go above the double top, which is around there, right? So your initial risk, if you were to enter here, would be about this much, right? Whereas if I waited for it to go up here, then my risk is reduced to this much, right? Which is a big difference. That's double. But like I said, from my back testing on specific currency pairs or whatever, I know that majority of the time it hits 61.8 and goes down. There are times where it does go back up there, but it's not many from what I can see, but it does tend to go up there. It depends on what you look at too. So that's your initial risk, right? Now your targets would be using the extension, doing the swing high to swing low, then back up, right? Where are we? Okay, so that's your swing. That's your fib extension. Okay, and I'm just gonna It's going to make it a bit more like that. Make it white. Okay. All right. So using Fibonacci extension, and you're looking for the 127 and the 161, okay, which is basically down here. So they're your potential target levels, right? So you can look for targets at the 100%, right? It's up to you. It's all dependent on your rules, man. That's why when people say, "Oh no, you're doing it wrong," blah blah blah. Well, it doesn't really matter, right? These are my rules. Some people might have different rules. Some people might take them a lot sooner, right? It doesn't really matter. There is no right or wrong answer, right? If it works for you, then it's all good. If it doesn't, then fine. So if you're looking at 100% as being the first target, then already you can see that you've got at least more than a 1-to-1 risk reward, which is already good, right? Because you always want your reward to be equal to or higher than your risk. So that's the first one, right? But I usually look for at least a 127. 127 extension being the first target level, right? So already there, you know that your risk is already 1 to 2, right? So that's good. That's like really, really good. So, so your stops already go there, and the market might fluctuate a little bit. Who cares, right? Your stops are up here. And if your stops were over here, then you would be concerned. But you know, you have to have them up here. And why do you have to have it up here? Because that's the next recent structure level. Okay, you wouldn't just have it here randomly like that. So that's your first. And then if you're looking for 168, right? Then you've got easily a 1 to 3 risk reward, right? Now, like I said before, right, you don't have to take the short. If you're looking for a long setup, right, to go long, then you just ignore all this, right? What I'm saying is you can use this technique to find where the market is likely to go if it does go down, right? So you can see already that the market's bearish, so it's bearish. There's no sign of it, reversing. There's no sign of a trend change, right? So that's the question, right? You're going to see what this is doing. So assuming that this holds, then the market's going to continue down, right? On the 1 hour or the 4 hour anyway. And the 161 and the 127 are potential target zones if you were to take the trade or not. But again, like if you're not taking it, you're just looking for areas to potentially look for an entry. So I'm just going to highlight that in, right? What I'm going to do is I'm going to go back to daily chart, right? Right, you can see the 161 right there, right? I've drawn that little triangle between the 127 and the 161. Now going back to what I drew earlier in terms of the fib retracement, I drew the retracement swing low to swing high, and it lands right on the 50%, right? Which is a good level. Anywhere between here and here is a good entry level, right? For a continuation. If it goes down to the 161, I'd be a little bit more concerned. But even then, like the 161, you can still get the bounce off from there, right? Now, if you look left, right, from where, let's say we were looking for the 161 as the target for the the 2618, but also a potential entry for the continuation trade. It sits right at structure, right? A lot of structure here. You can see there was a lot of congestion in there, a lot of market vibration, right? You go back further, you can see more, right? More signs of a structure. So that's already a good level. So I'm going to mark that in as being a potential, right? Now, next question is, I want to go back, now going back to the 1 hour. Now, there's a system I use to trade. I do it now without even thinking, which is it's called basically a CTS. It's a combined technical scoring system, which is basically you're looking for multiple signals, or it's like a scoring system, right? Where if you got this signal or that signal or this signal, and then if you added all the numbers up, the points up, and you get a particular score, say if it's a 6 or an 8, then it's a valid trade, right? If it's any less than the 6, then it's not a good trade, like that. But I won't get into that now. But if you're looking for measured move, I'll look for if measured moves are one of your signals, then you've got a potential measured move as well. Right, basically from here and there. So you've got a measured move A, B, C, D down into this level here. So within this zone, okay. So that's already a good signal there. It's not the best signal, but it's a signal, right? You can look for even more Fibonacci extension levels, right? So let's say you can look for the swing high there, down to swing low, back up. Then you've got a 161 right at the 127 extension with confluence. So that's really, really good, right? You know, you can do the extension levels as much as you like, really, but just thought I'd show you that bit. You know, you can do it from, say, up here, I guess, and then do it further down there to look for maybe a 127, right? Where I'm just trying to line this up. All right, so you get a 127 right there. So right now, you've got a lot of confluence at this level, right? Like how much more? Like that's really good because you're getting all these signals that are lining up with each other, right? I'll make this kind of thinner and I'll make that yellow as well, but I'll make it dash. Oh shit! So you can see what I'm talking about. So you got a dash. So straight away, I've got ABCD confluence with a 161 and a 127 Fibonacci extension. Okay. Let's see if I can look for another measured move, I guess. No, there won't be one there, but look at, say, 4 hour. So like I said, if you're looking for where it is likely to go, then you can use these techniques on the lower time frame to see what else is happening that could indicate that we could see more downside and a potential likely area for an entry. Now that it's down there, you're looking at structure here, you can see there's a range here, right? So even though I've got all this confluence there, right, just keep, this is what's important, right? If you're absolutely risk avert and you're really, really stingy, right, and you can't afford, where you enter, you can't afford, you want to have the absolute minimal risk, right? You can enter there, right? Enter long there for the move up and hold it, right? Your stops would go obviously below a structure level, which I'll get to in a minute. But, you know, you've got to be prepared to see the market. The market might continue down a little bit. Like I said, there's a range here, right? That it could go down to. The 61% is further down as well, right down here. So you're looking at, initially, at maximum, you could be looking at potential risk of this much. But this is where back testing comes in, right? If you've back tested setups like this, then you know that 70% of the time it will reverse between these levels here and go back up. So your initial risk, and you got to think about the big scheme of things on the daily chart, right? You're looking at the daily chart, right? That's still a fair bit of, oh shit, hold on, should be up here. Oh no. So on the daily chart, that's how much risk you're really looking at, right? Your stops will go below here, right? But your reward is like up here, right? The potential reward on this is high. I won't talk about targets too much because it's pretty obvious what targets are. The targets are at least up there somewhere, or higher, most likely higher. So that's a 1 to 3 risk reward already, right? So, like I said, or you can play it very conservatively and just go, well, I'm not going to enter unless it goes back to the 61.8%, right? It's up to you. This is all rules based, right? So you can enter here, and that way you can guarantee that you're in the trade, right? You're guaranteed that eventually, whether it's days or weeks, eventually it's going to go back up and whatever. Or what you can do is you can enter here, a smaller position here, right? Enter the first position, and then if the market comes back down, you can enter the second position. Right now, your risk is double because what if the market just keeps going down? Well, it's what can you do? That's just move on to the next trade, right? It happens, right? It's a numbers game, right? So everyone that trades knows that generally these are continuation setups. So 70% of the time it's going to reverse and go back up. The other 30% of the time you might keep on going down. But if you're trading this day in, day out, and you've got a 70% win rate on these patterns, then what does 1 loss or 2 losses matter, right? That's all it really is. That's really about risk reward and just probabilities, right? So there you go. So there's 2 entries. There's the entry range I'd be looking at is somewhere between at the very most 95.9893 area up until, and the earliest entry point would be the 103.68. Okay, so within that range, to be looking for an area to go buy. Now, as the market plays out, you'll start to find more clues, and you'll be able to narrow the entry down even further, right? But for now, there's not much for us to look at except for that. So going back to daily quickly, going back to this pattern as well, right? Right, just keep this pattern. If this pattern plays out, which it looks like it's playing out, then you're going to see a move, some kind of sharp move down initially, then some sort of rally. And that's why I start to keep telling people, like, you can predict what is going to happen from a fundamentals perspective. If the dollar moves down sharply, right, there's going to be some fundamental used in the background to back this up, right? It could be anything. It could be weaker dollar because of, I don't know, bloody, China devaluing this, or China doing this, or Europe doing whatever the case, whatever bullshit story they come up with, there will be a story to back this up, right? That's the whole point. And that's why people don't understand. People think that everything I say, it's a good conspiracy. But you can, when they're showing you what's going to happen, right? They're showing you in this price chart what is likely to happen. And these patterns appear all the time. So it doesn't become hard to predict what might happen in the near future, right? Now, if this pattern plays out as I expect it to, you're going to see them move down, right? And then you're going to see a reversal back up, right? Then they're going to come up with another story to say, well, the dollar's rallied because something, improved retail sales, or whatever crap they come up with. There will be a story to back this up. So if you can't see this, right, then basically, if you can't understand why these predictions can be made, then purely you don't know anything at all. You're just missing out. You're missing out on all this money that can be made, right? You're the ones that are sitting there struggling, or basically struggling to even make much money at all, or whinging about your, how everything's unfair, and, all this kind of stuff, whatever the case may be, right? You're missing out on all this. This is all planned, predicted. It's quite simple. So I don't understand. They're telling you what's going to happen, right? The price chart doesn't lie, right? The price tells you what's happened in the past, right, and what's about to happen, right? It's also the visual representation of all market participants, right, and their actions and decisions, right, their emotions, everything. And these patterns happen day in, day out, on the 1 minute time frame, on the daily, on the weekly. It doesn't matter. It happens. So if you're not taking advantage of this, then you're just missing out. That's all it is, right? And people like, those are the people that usually complain. The haters, basically. That's all it is, right? And I'm showing you right now which is an area to look for an entry. If you do get into this trade, could be a very, very profitable trade. So yeah. So I hope that helps. And if I see anything interesting like this, then one more thing. So just to sum up the setup, right? You've got multiple signals, right, around that are confirming that this level could be a level to look for an entry, right? You've got the ratio levels, right? You've got structure, right? I'm sure you've got an RSI as well. Maybe not now just yet. Well, you've got some bullish divergence, all right? See, the market's doing lower lows, but yet the oscillator is showing higher highs. Higher lows. So that's bullish. So that's three signals. If you go on a lower time frame, you got the setup at 2618 with potential targets at the 161. You've got this move here, this pattern move here, right? That's 4 or 5 signals. And you've got Fibonacci retracement and extension confluence on the lower time frame. So you've got about 6 or 7 signals there, all indicating that this level is a good level for a reversal. I don't need to say any more than that. So yeah. So all the best. I'll speak to you soon. Cheers. Bye.